I want to dwell on the power of active share, the power of active share, strategies for outperforming the benchmark. Active share investing is an investment approach that focuses on selecting stocks or assets that differ remarkably significantly from the benchmark or the index or the overall market. The goal is to achieve returns that deviate from the benchmark, potentially leading to a higher alpha. Alpha here means excess returns relative to the benchmark. So if an investment strategy is successful, you will certainly perform better than the benchmark, higher than the benchmark or the indices. So let's look at key features of active share investing. Number one here is active share metric. Active share metric. It measures the proportion of a portfolio's holding that differs from the benchmark index. A higher active share indicates a greater divergence from the benchmark. This it's like a kind of performance metrics, usually when your portfolio, your investments outperforms the benchmark to a larger degree. So in that case, you have a higher active shares. If it doesn't, that means you're having a lower active shares. Number two is fund manager's discretion. Fund manager's discretion. It relies on the fund manager's ability to make informed active investment decisions rather than passively tracking the index. In this case, the fund manager is quite active. He research a lot. When it comes to stock selection, is actively involved in the overall investment process. He's not passive. He's essentially active, and his decision in this regards is considered paramount. That will eventually determine the kind of result, the kind of returns the fund will obtain at the end of the day. There is potential for alpha. By deviating from the benchmark, investors aim to capture unique opportunities and generate returns that exceed those of the benchmark. Alpha here means a kind of deviation in returns from what the benchmark provides. So there's potential for achieving alpha. It's equally, higher risk and reward, because the strategy involves significant deviation from what is obtainable, in the index or from the benchmark. So it can lead to, high volatility and potentially generate higher returns. That is it. But the statistics shows that most managers hardly beat their respective index. That is it. Active managers, they hardly consistently beat the index. So let's look at advantages and disadvantages of this strategy. Under advantages, number one here is a potential to achieve superior returns by capitalizing on unique opportunities not captured by the benchmark. So you can fish out opportunities that are not really available to the overall benchmark. And so if you can harness this opportunity, there's a tendency that you could do very well in the market. Number two, it allows for personalized investment strategies based on thorough research and analysis. You could have a kind of customized, personalized, investment strategy. You could do that yourself. There's that flexibility and an allowance for you to be able to bring in your personal knowledge and experience and skills into investing. Number three is it can provide diversification away from benchmark holdings. In other words, you could invest outside companies that are listed in the benchmark. You could invest outside companies like listed in the Standard and Poor 500, S&P 500. You can invest away from those companies. That's a typical advantage here. You want to consider disadvantages. So in this regards, number one is high risk due to significant deviation from the benchmark. The more you deviate from the benchmark, the more risky your portfolio becomes, your investment becomes. There's potential for higher fee and trading costs. You trade frequently, and that will attract fees, and that will attract cost. The cost implication is significant. Number three, performance may be inconsistent and depends on the manager's skills. You don't, year in, year out, you actually have consistent results. The manager may perform very well this year. He may not obtain that performance next year. And also, the more skillful the manager is, the more experienced the manager, the better the result. So example of these strategies involve, number one, high active share funds. Mutual funds or ETFs that significantly differ from their benchmark index in terms of stock selection and weightings. That's an example. So these are mutual funds. They invest away from the benchmark. So you have concentrated portfolios, investing in a smaller number of high conviction stocks rather than a broader index. This strategy tends to encourage concentration, running a concentrated portfolio. Someone like Bill Ackman, he runs a concentrated portfolio. This thematic investing involved focusing on specific themes or trends that differs from the general market approach. You may also inculcate thematic investing. So use cases involve, number one, active mutual funds managed with a high degree of active shares aiming to outperform traditional benchmark. You equally have hedge funds. So they often use high active share strategies to differentiate themselves from market indices and to capture alpha. Because when it comes to hedge fund investing, please don't forget to like this video and subscribe to this channel. Usually when it comes to hedge fund investing, you discover that the managers will take 20% of the asset under management. That's 20% of capital. Sorry, 2% of capital and 20% of profits. That was they are popularly known as 2 and 20 fee structure. So it's a very important strategy that even the individual investor could adopt.